I want you to picture a house, a massive, beautiful, historic mansion right on the coast.
Okay.
It's listed for, say, $12 million. You walk in, you fall in love with it, the crown molding, the view, just the prestige of owning it.
Sure.
But you aren't the only one who wants it.
Yeah.
You get into this bidding war with another buyer, and the adrenaline kicks in, your ego takes over, and you end up paying way, way over the asking price.
You feel like a king holding those keys.
You feel like a king, but,
Mm-hmm.
and I feel like there's a but coming here.
Oh, there is definitely a but coming.
A massive but. You move in, and the roof caves in. The foundation cracks. You realize you can't even afford the heating bill because it's just astronomical. And 9 years later, you are so desperate to get rid of this money pit that you sell the keys to a complete stranger for $1 single.
That is a financial nightmare. But it's also, I think, a perfect analogy for what we're talking about today.
It is. Today, we are doing a deep dive into one of the most spectacular rises and falls in corporate history. We are looking at the acquisition of the European steel giant Corus by the Indian powerhouse Tata Steel.
This is such a classic business school case study. It's often taught as a lesson in, well, hubris. It started as this $12 billion trophy deal in 2007.
And ended how?
It ended with major assets being sold off for a nominal £1.
A literal £1 coin. So we're going to base this discussion on a really fascinating case study by Dr. Tiraj Jain and Ms. Ramani Kandeti. It's titled Tata Corus Deal, Where Did They Go Wrong?
Right.
And we aren't just going to look at the bad luck, and there was a lot of bad luck. We need to dissect the strategic errors, the psychological traps, and the specific management failures that turned a global ambition into, well, a deal from hell.
And that's the key, isn't it? It wasn't just one thing. It was a complete cascade of errors.
So let's rewind the tape, set the scene for us. It's 2007. The iPhone hasn't even fully taken over the world yet. The global economy is just roaring. What was the mindset at Tata Steel?
Optimism. I mean, unchecked, wild optimism.
Yeah.
You have to remember, in 2007, credit was cheap and globalization was the buzzword.
Right.
Mergers and acquisitions, M&A, were happening everywhere. Tata Steel was already a giant in India, but they wanted to be a titan on the world stage.
And they were, what, like 56th largest at the time?
Exactly, 56th. And they had a plan to jump straight to number 5.
Whoa, that is an incredible leap. You don't usually jump 50 spots in the rankings organically. That takes decades.
Yeah, oh, absolutely. Decades. So if you want to move that fast, you have to buy your way up. And the strategy they pitched to their shareholders had this very specific, slightly confusing name: a disintegrated business model.
Disintegrated usually sounds like something falling apart. I assume in this context it meant something else. Or was it, an accidental prophecy?
It does sound a bit ominous in hindsight, doesn't it? But at the time, it was actually a pretty clever logistical theory. Think of steel production in 2 stages. First, you have the upstream that's mining the iron ore, making the raw steel slabs. It's dirty, heavy, energy-intensive work.
Got it.
Then you have the downstream, rolling that steel into high-quality sheets for cars or, skyscrapers.
Okay. So where do Tata and Corus fit into this upstream-downstream split?
Well, Tata in India was sitting on these massive reserves of iron ore. They owned the mines, so they could produce that raw steel cheaper than almost anyone else in the world.
And Corus.
Corus, being an Anglo-Dutch company, didn't have that. They had to buy their raw materials on the open market. But what they did have were the high-tech factories in Europe and a really fancy client list, BMW, major construction firms, that sort of thing.
I see the logic. Tata makes the cheap slabs in India, ships them to Europe, Corus finishes them and sells them for a premium to Western customers.
Exactly.
It's like a relay race where the first runner is incredibly fast and the second runner has the best shoes.
That's a great way to put it. It's called vertical integration across geographies. Low-cost production meets high-end market access. On paper, it looks like a money-printing machine. And there was another factor: greenfield costs.
Right. Greenfield meaning building something new on a greenfield, literally from scratch.
Exactly. Building a new steel plant in Europe from scratch is a total nightmare. It takes years, costs billions, and the permits alone can take forever. Buying Corus was supposed to be a shortcut.
You buy an existing house instead of building one.
You got it.
But here's what I don't get. If the logic was so sound, why did it require such a massive gamble? Because this wasn't just a friendly merger where they shook hands over tea, was it?
No, not at all.
Mm-hmm.
And this is really where the psychology of the deal starts to overshadow the logic.
Okay.
Tata wasn't the only suitor. A Brazilian steelmaker called CSN entered the chat. And suddenly, it wasn't a negotiation anymore. It was a brawl.
A bidding war.
A severe one. Tata started by offering 455 pence per share, which, by the way, was already a decent premium over the market price.
And then CSN countered.
CSN countered. Then Tata countered back. This went on for months. And in the heat of the moment, the executives at Tata got tunnel vision. They just wanted to win.
It sounds like when people get caught up on eBay in the last 5 minutes of an auction.
Yes.
You stop caring about the item and you just start caring about beating the other guy.
That is exactly what happens in corporate boardrooms, just with a lot more zeros.
So how much did they end up paying? What was the final number?
The final gavel came down at 608 pence per share.
Whoa. So they went from 455 to 608. That's doing some quick math here. That's roughly a 34% increase.
It is. And remember, the original price already included a premium. So they paid a premium on top of a premium. In economics, we have a name for this. It's the winner's curse.
The winner's curse.
Yeah.
That sounds like a horror movie title. Break that down for us.
It's a paradox from game theory. In an auction with incomplete information, the winner is usually the person who overestimates the value of the item the most.
So, by winning the auction, you have almost certainly lost money.
Exactly. Because you paid more than the asset is intrinsically worth. You win the bid, but you lose the value.
You win the battle, but you've effectively shot yourself in the foot before the war even starts.
Precisely. And the market knew it instantly. This is the part that always amazes me. The day the deal was announced, Tata's stock price tanked by 20%.
20%?
Investors looked at the $12 billion price tag, half of which was debt, and just said, "You have made a huge mistake. You overpaid."
But Tata ignored them.
They brushed it off. Ratan Tata, the chairman, he famously said at the time, "I will not comment on the stock market reaction. History will judge the deal."
Well, history is about to judge it, and quite harshly, because the timing could not have been worse. They closed the deal, they popped the champagne, and then 2008 happens.
The global financial crisis, the ultimate black swan event.
And for steel specifically, why was 2008 so devastating? I mean, everyone suffered. Banks, homeowners, but steel got absolutely hammered.
It's because steel is what economists call a derived demand. Nobody buys steel just to have it sitting in their garage, right?
Right, you buy it for something else.
You buy steel to build a skyscraper or to make a car. And what are the first two things that stop happening in a major recession?
Construction projects get canceled and people stop buying new cars.
Exactly. Demand didn't just dip, it evaporated. So suddenly, Tata has all this new capacity, all these factories they just bought for a fortune, and nobody wants the product.
So Tata is sitting on $6 billion in new debt, and their customers just stop calling. But the case study mentions another factor, something big looming in the East.
The shadow of the Chinese market. This is so crucial. While Europe and the U.S. were panicking and cutting back, China was doing the exact opposite.
Right.
The Chinese government pumped massive amounts of money into infrastructure to keep their economy moving.
Right. Building whole cities. The Beijing Olympics were on the horizon.
Exactly. So Chinese steel mills were running hot. By 2014, China was producing 822 million tons of steel. That's nearly half the world's supply.
Wow.
But eventually, their own building boom slowed down.
But they didn't just turn off the furnaces, did they?
They couldn't. These are often state-backed enterprises. Closing a mill isn't just a business decision, it's a political one. It means firing tens of thousands of people, which causes social unrest. So instead, they just kept making steel and exported it.
And when you have way too much supply and not enough demand?
Prices crash. China started dumping steel into Europe.
Okay, can we define dumping really quickly? It sounds like they're just leaving it on the lawn, but it's a specific trade term, isn't it?
It is. Dumping is when you export a product at a price lower than what it costs to produce it, or lower than you sell it for in your own home market.
So they were selling at a loss.
At a loss, just to keep cash flowing and keep those factories running.
So if I'm Corus or Tata Steel Europe, I'm trying to sell my high-quality steel at a profit to pay off my massive debt. But the market is flooded with Chinese steel that cost half as much.
You can't compete. It's just impossible. And on top of that, just add insult to injury, the UK plants were facing a very specific, localized problem: energy costs.
Right, the case study highlights this. UK energy prices were way higher than in Europe, weren't they? I remember reading something about green taxes.
Much higher. By 2015, UK steel producers were paying about 9.55 pence per kilowatt hour. That was double what they paid just a few years before, and significantly more than their competitors in France or Germany.
Why the difference? Was the UK just more expensive in general?
It was policy-driven, green taxes and carbon reduction policies. Now look, the goal of those policies is noble fighting climate change.
Well, score.
But for a heavy industry like steel, which uses these massive amounts of electricity to melt iron, it just destroyed their margins. They were paying an environmental premium that the Chinese competitors certainly weren't.
Okay, so let's pause and just look at the board. You have massive debt from overpaying.
Yep.
You have a global recession that killed demand.
Right.
You have cheap Chinese steel flooding the market. And you have high energy bills at home.
It really does sound like a perfect storm of bad luck.
It does. And if the story ended right there, you'd probably say, poor Tata, they just got unlucky. But the authors of this case study argue that's not the whole truth. They say the internal failure, the management, was just as responsible.
That's the controversial part. It's always easy to blame the economy. It's much harder to look in the mirror. The case study argues that Tata acted like a financial buyer instead of a strategic operator.
What's the distinction there? Because they sound kind of similar.
A financial buyer buys a company, keeps the existing management, and just hopes to squeeze out some profit or maybe sell it later. A strategic operator goes in, tears down walls, integrates systems, and actually runs the show to create something new.
And Tata?
Tata bought Corus, but they didn't really run Corus.
There's a quote in the source material that really stuck with me on this. If a company acquires another company, it has to be present as the executive authority and not as an advisor.
That just hits the nail on the head. Tata kept the existing Corus management in place. You had this revolving door of CEOs, Philippe Varin, then Kirby Adams, Carl Kohler, but there was no Tata team that landed in London to take charge. They treated Corus like a separate kingdom.
Why? Was that a cultural thing? Were they just trying to be respectful?
Likely, yes. They wanted to be seen as a benevolent owner, not some hostile conqueror. They thought, we're all friends here, India and the UK have a shared history. But in M&A, benevolence can be fatal. If you don't integrate, you don't get the synergies.
Synergies. The magic word in every merger. We'll combine and save money. Why didn't that happen here?
Well, let's break it down. You usually look for hard synergies, which is just a polite way of saying cost cutting.
Right.
Tata thought they could just slash administrative costs. But they completely underestimated European labor laws. You can't just fire 2,000 people in the UK or the Netherlands like you might be able to in other markets. It takes years and costs a fortune in severance.
And the soft synergies, the idea that they could, cross-sell to the same customers.
That failed too. I mean, think about it from a customer's perspective. If you are Ford or BMW, do you really want to buy all your steel from one single company?
Probably not, no.
Yeah.
If that one company has a strike or a supply issue, your whole factory shuts down. You're too exposed.
Exactly. You want supply chain diversity. So when Tata and Corus combined, the customers didn't double their orders. In some cases, they actually pulled back to spread their risk, so that revenue boost just never happened.
So they didn't cut costs and they didn't increase revenue.
In fact, they got diseconomies of scale.
Which is the exact opposite of what you want. You get bigger to get more efficient, not to get slower.
The company just became this bloated giant. Decision-making slowed to a crawl. The R&D teams in India and Europe didn't talk to each other. They were using different software, different processes. The complexity of running this beast just grew faster than the money coming in.
It really seems like they underestimated the cultural gap too, not just East versus West, but more like low cost versus high tech.
It was a separate unit problem. The case study says Corus engineers kind of looked down on Tata's operations as basic. And Tata executives felt the Corus team was arrogant and expensive. Because they didn't force integration from day one, those tribes just entrenched themselves. There was no oneness.
And while all the executives were having their culture clash, the financial reality was just rotting away the floorboards.
The numbers are staggering. Remember that brilliant strategy of using cheap Indian raw materials? Well, global commodity prices shifted. Raw material costs for the group jumped from 20% of production costs all the way up to 70%.
70%.
Yeah.
That just wipes out your margin right there.
Completely. By 2014, the Tata Group was sitting on $13 billion in debt. The UK operations were just bleeding money every single day.
And when a company bleeds money like that, it's not just numbers on a spreadsheet. It impacts real people. The case study mentions a specific, awful tragedy at the Port Talbot plant in 2012.
Yes, the death of Kevin Downey. It's a heartbreaking story, and we need to treat it with respect, but it is relevant to the management failure. He was a worker who, wandered into a channel of molten slag waste material at incredibly high temperatures.
That is just horrific.
It is, and the investigation showed that the area wasn't properly lit and safety barriers were insufficient. The company was fined £500,000. But beyond the money, it was a symbol.
A symbol of what?
That when management is obsessed with debt restructuring and just pure survival, sometimes that fundamental focus on operational safety can slip.
And then came the layoffs.
Thousands of them. 1,500 jobs gone at Redcar, 600 at Port Talbot, 900 at Scunthorpe. I mean, these are whole communities that rely on the steel works. When the plant shrinks, the town shrinks. It's just devastating.
Which leads us to the finale of this story. The moment that really encapsulates the whole failure, the £1 sale. Explain how a company sells a massive industrial division for £1.
It's a distress sale. In 2016, Tata was so desperate to stop the bleeding that they sold the Scunthorpe plant and the Long Products division to an investment firm called Grable Capital.
For a nominal £1.
Yes. But Grable wasn't really paying a pound for the assets. They were agreeing to take on the liabilities. They were essentially saying, we will take this problem off your hands so you don't have to pay the daily losses anymore.
From a $12 billion headline acquisition to a £1 disposal, it is just breathtaking.
It shows you just how toxic the asset had become. They were willing to literally give it away just to save the rest of the ship.
So if we zoom out, if we look at this not just as a steel story, but as a business lesson, what is the big takeaway here?
I think the core lesson is about the value gap. There was this massive gap between what Tata paid $12 billion and what the company was actually worth. But the tragedy is that they never built the bridge to cross that gap.
Because they didn't integrate.
Right. Integration isn't something you do 6 months after the deal. It's something you should be doing during due diligence. You need to know exactly how the cultures will mesh, exactly whose job is redundant, and exactly how the technology transfers before you sign the check.
So they treated it as a financial transaction.
Exactly. They bought the house, but they never really moved in.
That's a great way to put it. Buying is the easy part. Operating is the hard part. Anyone with a credit card can buy things, but making them work is the real job.
And I'd leave you, the listener, with this thought. In business and even in our own careers, we are often obsessed with growth. Bigger is better. Winning the bid is the goal. We celebrate the CEO who makes the big acquisition.
Right, we celebrate the signing ceremony, the big handshake.
But maybe we shouldn't. The Tata Corus deal forces us to ask, is winning the auction actually just the first step toward losing the war? And does the concept of too big to fail actually mean something else? Does it mean too big to manage?
Too big to manage. That is a haunting thought for anyone trying to scale a business. It's a reminder that strategy without execution is, well, it's just a hallucination.
Absolutely.
Thank you so much for walking us through this. It's a tough story,
Yep.
but the lessons are just invaluable.
My pleasure.
And to you listening, thanks for diving deep with us. We'll see you on the next one.